So you're considering paying off your mortgage early, but also you know that there's opportunities to invest your money instead for potentially higher returns. So you might be wondering which one is the right one. Should I just pay off my mortgage early to save some time and money, or should I take on the opportunity to invest in the markets? And now I know there are several videos on YouTube that talk about this topic, but there is a third option that I want to introduce you to and get you to start considering this option as well. So what we'll do in this video is that we'll take 3 scenarios and compare them side by side. Scenario number 1 is just taking any extra funds that you have and participating in an opportunity to invest. Scenario number 2 is we'll illustrate what it looks like to pay off our mortgage early and then start investing afterward with the extra funds that we have. And then scenario number 3, we'll go and illustrate this mysterious scenario and the option that you might want to consider. And with each of these scenarios, I'm going to give you some caveats and factors that you may want to consider. And my job here today isn't to sway you to do one or the other, but to simply present different factors and variables that could help you make the right decisions. And at the end of the day, there is no ultimate right or wrong answer when it comes to achieving financial peace of mind, because everyone has a different definition of what that is for their own situation. So with the setup out of the way, let's go and dig right into each of these scenarios using a spreadsheet to give them an apples to apples comparison as much as we can. So let's go and start out with scenario number 1, and that is we're not doing any extra payments to the mortgage. We're simply going to take any extra cash flow and savings we have and invest and participate in the market. So a couple of assumptions here, and all 3 scenarios have the exact same mortgage information. So we're going to start with a $500,000 mortgage, the 5% interest rate, 30-year amortization starting in January 1st of 2025, and the given parameters we have is $2,684.11 for the principal and interest payment, 360 payments total, and the total interest we're paying for this given scenario based on the inputs is approximately $466,278. And so with each of these scenarios, the constant will be the mortgage. The mortgage information will remain the same with all 3 scenarios. What may change, of course, is the interest output, the cost, as well as the net benefit for all 3 scenarios. And so some of the further assumption is that we have $1,000 of cash flow, 7% return on market, and that's looking at the past 20 years of inflation adjusted S&P 500 returns. Now I have some more asterisk, I'll bring them up later. And we're going to take all of our cash flow, 100%, to allocate towards investing. Now you'll notice down below, I just took a screenshot from an investment calculator. You can get this for free. Just type in investment calculator on Google. You'll find the exact same one that I'm using. So we're starting out with a $0 balance on our investment, but we're assuming that we're going to invest $1,000 every single month into this fund, earning 7% annually. As you can see, $1,000 every single month. So given that parameter, investing $1,000 every single month, 7% interest, compounding over the next 30 years, we're gonna have an ending balance of $1,169,452.60. Not bad at all. That's pretty darn good. You can see our contribution has only been $360,000 out of our pocket cash flow, but the total earnings, interest yielded from this investment is approximately $809,452. Very impressive. So as you can see from the get-go in scenario number 1 of simply just investing, we have massive opportunity costs if we didn't choose to invest. So that's scenario number 1. But this is just a hypothetical illustration on paper, and that's assuming that every single year we can have a reliable return of 7%. Unfortunately, that's not realistic at all. As you can see, I pulled up a 90-year historical chart on the S&P 500 index, and as I scroll down on the chart, you can see some stellar returns on the S&P 500. But looking back to the last 20 years, there are instances where the S&P 500 delivered a negative return, such as 2008, 2018, a little bit of 2015 as well as 2022. But what most people fail to understand when it comes to looking at a chart like this is that when there's a negative return on the back of a positive return, the negative return actually has a more weight to the drop. In other words, it would take a significantly higher positive return on investment to recover from a loss. So for instance, if we were to go back in 2008 where the S&P 500 lost 38.49%, it wouldn't take 38% to recover from that. You will need more than a 38% positive return to come back to where you've been previously. So if you didn't understand that concept, don't worry, I'll have a separate video later to explain the relationships of positive and negative returns when it comes to investments. But for right now, let's go back to scenario number 1, wrap that up, and we'll move on to scenario number 2. So coming back to scenario number 1, just understand that 7% return on market with a 20-year inflation adjusted on the S&P 500, it's not gonna be always 7% every single year. So just remember that fact. Now, the other variable that we need to consider to make this as realistic as possible is taxes. Now, of course, this is a different story if you invested into a tax-deferred account like a 401k or an IRA, but we're gonna assume that you invested into a brokerage account that isn't qualified for any tax deferment treatment. So in this scenario number one, if you were to take the entire $1,169,000 out in a given year, then you would end up owing approximately $161,000 of capital gains. And here's how I arrived in that number. If you're taking the entire $1.1 million out in 1 year, that would almost automatically put you at the highest capital gains tax rate of 20%. Now, just a disclaimer, I'm not a tax attorney, I'm not a tax professional, so please consult with your tax professional for your given scenario. But to give you a textbook answer based on what the IRS says, if we're making one-time instant draw of the entire investment balance, then yes, we would have a significant gain that we would have to report to, which trigger a tax liability of approximately $161,000. So if we factor the capital gains tax at the time of liquidating this fund, we would have a post-tax net of about $1,007,562. And remember, this whole thing, the $1.1 million isn't taxed necessarily because we have to factor in the basis, the contribution you made of $360,000. And from my understanding of the tax code, that portion is not taxable. What is taxable are the gains portion of it. So throughout the other two scenarios, we will be factoring tax as a variable to consider when it comes to comparing the net benefits, the risks, the pros and cons. So let's go and move on to scenario number two, where we are now officially illustrating what it would look like to take all of our excess cash, pay off our mortgage first, and then use the freed up cash flow to invest from there. So as you can see, same exact information for our mortgage, same input, but the difference is that we're making our $1,000 optional extra payment every single month until the principal balance is fully paid off. And consequentially, our total interest is of course less than the original mortgage interest, which the new interest now is $238,541. Let me change that to red. And our original interest was $466,278.92. So the interest savings, basically what we didn't have to pay because of the extra $1,000 every month, is approximately $227,737. Now that also means that we got to actually pay this off earlier as well, approximately 159 payments less. So 159 months or 159 payment translates to about 13.25 years. So that's 13 years and about 3 months. So now the question is, what if we take the $1,000 of extra cash flow we had plus the monthly payments that we don't have to pay on the mortgage, we take that and invest instead. So basically we're deferring or delaying where and when we get to start the investments. So as you can see, if we scroll all the way down, we're done 159 payments earlier, we're paid off, no more mortgage payment. And so we take that 13.25 years, same return on investment, keeping everything consistent as possible, 7 years, and our contribution now has changed and increased to $3,684. Remember, that's because we no longer have a mortgage payment and we're taking the $1,000 of excess cash flow we had before and applying it to aggressively grow our investment. So if we do this for 13.25 years, the end result is that we would have a balance of $945,407. Obviously, that's less than scenario number one, where we strictly took the $1,000 and invested in the market instead. So you can see total contribution, we have a lot more contribution this time and less of an earned interest. So the ending balance after 13.25 years of investing this amount every single month, the ending balance is $945,407.58. Now, compared to scenario number one, you definitely earned less of a total interest and you definitely had a lot more contribution to this investment fund. But because the principal was larger in the contribution and less interest was earned, this ultimately changes some of your tax situation as well, where the capital gains only applies to the gains. So our capital gains taxes is $71,926, assuming you're at the highest bracket of 20%. So the post-tax net is $873,480. And again, that's all assuming that we're gonna make a one-time draw upfront on this investment fund. But I also wanted to look at the net benefit of saving money on the mortgage side and also the money we've earned, the interest we accumulated on the investment side. So what we've done is I've taken the interest savings, right, of $227,000 up here and added it to the investment balance, the total investment balance of $945,000, and subsequently get $1,173,145.24. And of course, considering the tax ramification, if we are subtracting the capital gains, we would end up with $1,101,218. Now, speaking of taxes, to be fair, I didn't include the tax deduction on the interest, the mortgage interest cost. But remember, you only can take the interest cost deduction only when you're itemizing your deduction. If you're taking standard deduction from the IRS, then you aren't going to be able to claim the interest cost deduction on your mortgage. So keep that in mind. But to keep things consistent for this video, I'm going to go ahead and eliminate the tax deduction question from all scenarios so that we can get consistent inputs and outputs on all scenarios. Now, what's interesting when looking at the post-tax balance plus the interest savings that we earned because we paid off our mortgage early, right? This appears to be a significantly higher number than this, right? Almost $103,000 of difference. That's because the tax on the capital gains, so $809,000 of interest, is eating up a huge chunk, right? $161,000 of taxes from our investment. Whereas in scenario number 2, because we have a less of a gain but more of a contribution, we have less of a tax liability on the gain. And of course, that's reflected with the smaller tax amount of $71,926. Again, I'm not a tax professional, I'm not a tax accountant. I'm giving a very surface level answer without all the nuances when it comes to the tax laws. So factoring in the post-tax balance of our investment of only investing 13.25 years, albeit yes, we're contributing a lot more, and the interest savings we earned because we paid off our mortgage faster, we could have a potentially higher balance or net benefit at the end of the day when paying off our mortgage early and then investing after the fact the mortgage has been paid off. So before we get into the mysterious scenario number 3 of the hybrid way, you also have to think about the psychological benefit as well. By paying off our mortgage early, we have now decreased what I like to call lifestyle risk. Meaning, in the span of 30 years of paying off your mortgage, what if you lose your job? Maybe there's a career change where income significantly drops. What if there's a medical emergency? There are literally thousands of different life scenarios that may happen to you that could derail you from a financial standpoint. So by paying off our mortgage early and eliminating the monthly payment on our mortgage, not only could it give us better financial position, but we also have financial peace of mind. If you do lose your income or your income significantly drops, it may cause less of a stress on your finances. And just like what I explained to you earlier, that 7% return on investment isn't always guaranteed. But then ultimately, you may have a different financial goal. Your way of getting financial peace of mind might look completely different than mine, than someone else's, than some of our clients. Maybe you have a different expertise or knowledge that could get you better returns on the market. Maybe because you have a special training or niche knowledge into, say real estate or cryptocurrency, whatever the case might be, your risk-adjusted return may outperform the S&P 500, and therefore it might be worth it to just go all in on investing. And I know for some of you, it may sound like I'm swaying you to paying off your mortgage early, because yes, we do have a service and programs that helps you with that. But we can't ignore the fact that if you are a value creator, meaning you're an entrepreneur, you have special investment skills, maybe you're a day trader, those types of expertise and knowledge may put more weight towards the benefit of investing over than just paying off your mortgage early. So again, my job here, guys, is not to sway you one way or another, but simply give you factors and variables to consider so that you can think on your own as to what could be the best scenario for you moving forward. All right, so let's go and move on to scenario number 3, the moment you've been waiting for, the mysterious scenario where you could potentially get the best of both worlds of not only paying off your mortgage faster and saving some money interest there, but also being able to participate and also being able to invest some of your money into the markets, getting best of the both world and kind of optimizing for both. So here's scenario number 3. Let me go and paint the picture. Again, the mortgage information is exactly the same, 500,000, 5%, everything plays out. Now, the premise of this scenario really starts with the question of what if we take the extra $1,000 that we have as a cash flow and not pay off our mortgage completely, but stop at a specific point where we maximize our potential interest savings and from that on start investing into the market instead. So here's what that looks like. So if we scroll down, and I highlighted this part on payment number 92, you can see even without the $1,000 of extra payment every month, the principal portion of our monthly payment on the mortgage is now larger than the interest payment. So you can see here on payment 93, the principal payment is $1,346, which is larger than the interest payment portion of our P&I, $1,337.37. So from payment 93 and beyond, our mortgage payment, the P&I, is going more towards reducing principal than the cost of interest. So it's a lot more efficient than earlier parts of our mortgage amortization. More of our payment was going towards interest. So without this $1,000, we would have only paid $600.77 to principal, whereas the interest cost would have been a whopping $2,083.33. So pretty darn expensive and very inefficient in terms of reducing the principal. So the idea is, let's use our cash flow, the $1,000 of excess capital that we have, to reduce the principal down, or at least get to a point where our monthly principal payment is getting to be more efficient and it's working in a way that's in more favor to us. Now, once we're done from payment 93 and beyond, we're gonna stop paying extra into the existing mortgage. We're gonna go and then start investing instead. So here's what that scenario looks like here on the right side. So we start with zero amount, okay? Same thing like other scenarios. For the next 13.8 years, we're gonna go and put in $1,000 every single month with an average of 7% return. Now, the reason why I chose 13.8 years, and that is because we actually are going to pay this mortgage off faster. In fact, we only have a total of 258 payments as opposed to 360 payments, which equals to 30 years. So because we're able to pay this off shorter, I'm actually gonna break this down into two investment scenarios. One is the $1,000 that we're gonna put in for the next 13.8 years, but because we are able to pay off our mortgage faster, we now have freed up cash flow because we no longer have a mortgage payment. So the second scenario that I'm painting is for the remainder of the 30-year window, which is about 8.5 years, we're gonna take all of our freed up cash flow now that we don't have a mortgage payment and aggressively invest into the market. So 8.5 plus 13.8 years plus the months that we had to do extra payments, that should equal to be about 30 years. So that's what we're painting. So basically the first 92 payments, we are making extra payments to the mortgage to save some costs on the interest and to reduce the time we spend on paying this mortgage. The next chunk of time, which is 13.8 years, is where we still have a mortgage payment, but we now have that $1,000 going to the market. And then the last, kind of the third chunk, which is about 8.5 years, we're now aggressively investing instead. So here's what the result could be. The first scenario for investment is we're just doing $1,000 a month, starting with zero balance for the next 13.8 years, 7%. We could end up with the end balance of $273,052.25. So we accumulated about $107,452 of interest. Okay, but we also have to look at what would that look like if we were to continue beyond and start aggressively adding additional contribution to our investment by $3,684.11. And because at the end of this first scenario, we ended up with $273,000, that's what we're starting with on the second scenario. You can see that the starting amount, right? $273,000. So the next 8.5 years after the first 13 years, we could end up with $991,771.60 for our ending balance for the investment. Total interest, $342,000 gained in this particular scenario. So when we combine it, it's about $991,771.60. We're applying the top bracket rate of 20%, assuming we're liquidating the entire amount. So $90,078 is our capital gains. So the post-tax net would be $901,692. If we combine just the top line, pre-tax amount with the interest saving we also earned from paying this mortgage off early, which is approximately $182,000, we have $1,173,913. After taxes with our investment is $1,083,835. Not bad. I mean, we compare that to scenario number 2, where we're not too far away. I think it's a difference of about about $18,000 of a net difference, which is not bad at all. Plus, we save some money on the interest, right? Even with scenario number 3, which even the interest saving is pretty astronomical. There is some difference as far as scenario number 2 and scenario number 3. It's only about $40,000, $38,000 of difference in interest costs. So we've kind of got a little bit of everything, right? We were able to reduce the mortgage payoff by about 8.5 years. We actually also saved quite a bit of interest as well. And we earned pretty decent return, right? Assuming 7% return with these types of scenarios. Not bad at all. Again, the point of this video is not to sway you one scenario or the other. The whole goal is not to have you think black and white when it comes to money. There are different strategic things you can do that's a little bit different, can get you optimized for different things. So I want to help you think about the nuances as well as different realistic factors that may play a role in making the decision when it comes to should you invest, should you pay off your mortgage, or could you do something like this, a hybrid model, right? Again, this is assuming that's a 7% return. Obviously, if the market's doing way better than 7%, this could look dramatically different at 10%, 11%, then yeah, I can see the benefit shift towards more so investing instead, or maybe doing a hybrid model as opposed to paying off a mortgage faster. Again, the goal wasn't to claim one is better than the other, but more so help you start thinking differently about making these types of decisions, different factors and variables, and so on. So as a recap of the 3 scenario number 1 was strictly, let's go and just focus on investing instead and forgetting about paying off our mortgage early. In this scenario, we take in $1,000 of cash flow for 30 years, 7% return, and we could end up with $1,169,000. If we factor in taxes, obviously this is the post net. Scenario number 2 is, well, let's go and pay off our mortgage completely and as fast as possible, throw all of our excess cash flow there, save money on interest, but after we're done paying off our mortgage, then let's go ahead and start investing, which you can see the ending balance is slightly different. We also have to factor in potential capital gains as well as the post-tax net. And of course, after factoring the post-tax situation as well as the interest savings, we could end up with $1,101,000 of net benefit. And then scenario number 3 is kind of like, it's like a buffet, right? You get all 3 kind of at the same time, where we optimize for interest savings, okay, $182,000 savings. We paid off this mortgage in about 8.5 years early. We also get to participate in the opportunity to invest also in the markets. And so by doing so, we would end up with a post-tax net of $901,000 on the investment side. If we couple that with the interest saving potential, then we have $1,083,000. So again, all these 3 scenarios, I try to keep them consistent as far as the different variables and factors we're thinking about. But the goal here was to help you think in different scenarios strategically, thinking creatively about what could be possible. And so that is the goal of this video. And I know the third option isn't something that a lot of people think about, right? We often think binary, either pay off our mortgage early or we just invest, right? But there is an option for doing both, not necessarily at the same time, but in a sequential way of organizing or allocating our cash flow in the right direction to get the maximum benefit of both worlds. How can we save time and money on paying off the mortgage, but also how can we capitalize on the investment opportunity in the markets, whether it's S&P 500 or real estate, crypto, whatever could be your financial goal. So with that being said, the goal of this video was to make you think. So I hope that's what it did. And if you have thoughts, questions, concerns, or maybe you might be challenging the way that I did this, feel free to leave it down below, and I would love to make an improvement video or factor in some of the concerns that you may have and come back with a version 2 of comparing the 3 scenarios and make it even more realistic. So having said that, I hope you enjoyed this video, got some value through it, and made you kind of think, and I hope that this video played a role in making a better decision when it comes to your finances. So if you enjoyed it, be sure to subscribe, like this video, and we'll see you in the next video. Take care.